Fund Supermart, your online gateway to unit trusts.
What is your outlook for Asia, especially after Brexit and the lingering concerns over China's slowing growth? Is it a good time to invest in the current climate?
Overall, I think if you look at Asia from a relative standpoint, Asia still has the highest growth rates compared with the other major regions in the world. The concerns over Brexit were very real. Post-Brexit, we saw how the markets reacted. But judging from the behavior of the market so far, Brexit looks like it's a localized event. So it affects the UK, to a certain extent Europe, but I don't think the repercussions are significant enough to disrupt what's happening in Asia in a major way. As far as slowing growth in China, that's been the case for the past couple of years. I think that will continue. China will muddle through because it has to address the imbalances within her economy, and therefore slower growth would result. But slower growth in China still means about 6%, 6 to 7% growth. So overall, I think as far as Asia is concerned, from a relative standpoint, the fact that Brexit has happened, interest rates will remain lower for longer. And given that Asia, as I mentioned earlier, has got stronger growth, has got higher dividend yields, we are beginning to see more and more inflows into this part of the world, at least in the short term.
How much further upside is there for investors, and are valuations and earnings outlook appealing?
We don't generally try to guess, and the truth is it's a guess, how much more upside there is to the market, because internally we don't have targets for the benchmarks or the indices. For us, it's really about scouting around for the opportunities which we believe are still present in Asia. In the current environment, the lower for longer interest rates, or what we call a lowflation environment where growth is slow, interest rates will remain low, inflation is low. We believe there's a certain style or strategy of investing that would work best. And that strategy would be to focus on dividend income growth. So by and large, the way we're managing our portfolios, our funds, is to position in income-generating securities, be it bonds or equities, and overlaying that with stock-specific or sector-specific ideas, which I think if you dig hard enough, you can still find within Asia.
Which countries within Asia you have the most and least preference for?
Within Asia, where we have expressed our bets, and I use bet not in a gambling sense, but where we've expressed our conviction is by being quite highly invested in the TIP countries. TIP stands for Thailand, Indonesia, and Philippines, because we believe that those three countries have got their own catalysts that would drive the markets higher. Indonesia, for example, it's the reforms that have taken place, the political stability that has resulted, 1 year post the elections, the infrastructure pump priming that's happening in Indonesia. I think that augurs well for the Indonesian market, and it's proved to be the case. Indonesia has fared well on a year-to-date basis. The other market that has done very well on a year-to-date basis is actually Thailand, and we also have got exposure to Thailand in a similar space because the government is embarking on pump priming, fiscal stimulus, and that has helped certain sectors in the Thai stock market. Philippines as well, with the new president leading up to the elections and post the elections. The new president seems to be very driven to stimulate the economy. So again, there are specific sectors or companies there which would benefit from the measures that will be taken.
Any least preference?
Just from a top-down basis, and even if we do not prefer a country, we still should be able to identify stock-specific ideas. But just from a top-down perspective, within Asia, unfortunately, Malaysia is not one of our preferred countries within an Asian context. The other country where we are less exposed to is Singapore, except for the REIT space, but apart from the REIT space, Singapore is not a market that we are highly invested in. The other country that we like from a macro long-term standpoint, but we struggle with in terms of valuations being expensive, is India. So if I were to name the 2 or 3 markets that we are not so excited about, it would be Malaysia, Singapore, and India.
Does Asia offer itself as a good investment destination for dividends, and what should investors consider if so?
Asia clearly stands out in terms of dividend investing, and I think we all have to be realistic about the current environment. I always tell people that, you know, what used to be high dividend 3 years ago would have been a stock that gives you 6 to 7% dividend yield. Today, a stock that gives you 3% dividend yield in an Asian context is already considered a high dividend stock, because we're living in a 0% interest rate environment. So relatively, a stock that gives you 3%, 4% is considered high dividend yield. And within those parameters, Asia stands out globally. Asia has, in aggregate, has the highest dividend yield amongst stock markets globally. That's at the surface, but if you drill deeper, what is even more supportive of dividend investing in Asia is that the dividend payout ratios are lower in Asia. And the other point I'd like to add about dividend investing in Asia is that the spread of dividend paying companies in Asia is a lot broader, as opposed to other regions where the companies that pay high dividends are very concentrated or much narrower. If you look at Asia and you break down the Asian indices, more than half of Asian companies pay dividends above 2%. And you may laugh, 2% is no big deal, but as I said, we live in a 0% interest rate environment. So the spread of dividend paying companies is a lot more in Asia, and the dividend payout ratios are still low, which means that these dividends should be more sustainable going forward.
For Malaysia, do you think small cap segment is a better investment opportunity at this point of time as compared to the big cap segment, and why?
I don't think we are in an environment currently where you can just cut and dry. It's not so cut and dry that small cap will do better than big caps or big caps will do better than small caps. In a bull market environment, yes, small caps tend to do better because there's excess liquidity, people are a lot more willing to take risk. But I think you and I know we are not currently in a bull market. So it's not so simple. I don't think small caps would do better. I think it is very much, it comes down to specific stocks, specific catalysts. So just to give you an example, within the Malaysian context, the smaller cap or mid-cap contractors, those that are piped into infrastructure spending, construction spending, those stocks have done well, right? So those small mid-caps. But at the other side, you've seen some large caps do well. Stocks like Tenaga is up 9% year to date. It's no big deal, but you know, 9% is fairly good for a large cap. We've seen stocks like FNN, which is a large cap. It's up 20% year to date. So the short answer to your question is I don't think you can say small caps would do better than large caps or large caps would do better than small caps. I think the current environment is one of stock picking, picking out the right themes, and hopefully you can generate some returns there.